All right, let's just get right into it. There is a financial time bomb, and it's strapped to the chest of the American middle class. And you know what? The fuse is already lit. Today, we are breaking down the massive credit card crisis that could trigger a meltdown, one that could make 2008 look like a warm-up.
So let's start with a number, $1.13 trillion. This is the number that should honestly keep you up at night. For the very first time in history, total American credit card debt has soared past this mark. Think about that. That's more than the entire economy of most countries on Earth. It is an astronomical figure, and what's scary is it's getting bigger, faster.
And this is what makes that mountain of debt so incredibly toxic. The average interest rate on that trillion-dollar balance is now a staggering 24.5%. That's the highest it's been in modern history. Some cards, they're charging nearly 30%. I mean, at that point, you have to ask, is it even lending anymore, or is it just loan sharking?
So you got to understand, this isn't just a bunch of individual people with personal finance problems. No, this is a systemic threat. We're talking about millions and millions of Americans who are just one unexpected bill, one emergency away from total financial collapse. And when that happens, it creates a shockwave that could seriously impact every single one of us.
So, the big question is, how in the world did we get here? How do we become a nation literally drowning in high-interest debt? Let's break down how this bomb was built.
The sheer scale of this is, well, it's staggering. If you go back to 1980, the total credit card debt in the US was under $100 billion. Today, it's over $1.13 trillion. That's more than a 10 times growth, even when you adjust for things like inflation and population. The curve on the chart has gone almost vertical. It's a runaway train.
You know, it wasn't just one thing. It was really a perfect storm of factors that created this debt mountain. For about 40 years, real wages for the average person have barely budged, but the cost of everything, housing, healthcare, education, it soared. So credit cards filled that gap. At the same time, it became way easier to get credit, and culturally, carrying debt just became normal. And then the final blow. The Federal Reserve's recent rate hikes sent the cost of carrying that debt into the absolute stratosphere.
Okay, so we've seen the scale of the problem. But the real horror story is how this debt trap actually works on a personal level, how it destroys lives and futures one person at a time.
The math behind this whole system is it's cruel. Let's just run the numbers. Let's say you have an $18,000 balance at that 24.5% interest rate. If you only make the minimum payment, around $360, it will take you over 30 years to pay it off. And in that time, you'll pay over $33,000 in interest alone. That's almost double what you originally borrowed. It's an impossible treadmill.
So how does someone get caught? Well, it usually happens in stages. It almost always starts with an emergency, a car repair, an unexpected medical bill, something you have to put on the card. Then comes the balance trap, where you just can't quite seem to pay it off, and carrying that balance becomes a normal part of your life. After that is the interest spiral. This is where the compounding interest actually starts growing faster than your payments. You're running as fast as you can just to stand still. And finally, you miss a payment, and the whole thing collapses into collections, and for many, financial ruin.
Now, here's a little peek behind the curtain, a term the industry uses that they probably don't want you to think too hard about. Their most profitable customers? They're not the people who responsibly pay their balance in full each month. Nope. They are the revolvers. That's the industry term for people who are trapped carrying a balance from one month to the next. The entire business model is designed to create and keep people in that profitable state of debt.
Okay, so let's zoom back out. Let's see how this builds from a series of personal tragedies into a full-blown systemic crisis. Because this isn't just about the people in debt. It's about the stability of the entire economy.
On one side, you have personal debt. It creates unbelievable stress, it wrecks credit scores, and it can destroy families. But when millions and millions of people are in that exact same boat, it all adds up to something much bigger: systemic risk. Mass defaults can literally trigger bank failures, cause credit markets to just freeze up, and lead to widespread job losses for everyone.
And here's how that chain reaction could play out, like a line of dominoes tipping over. First, consumers max out their credit, and they just stop spending. And since consumer spending drives 70% of our economy, that means retail and service industries start to collapse. This, of course, leads to mass layoffs, which means even more people can't pay their bills. And finally, a massive wave of defaults hits the banks, triggering a full-blown financial crisis.
So the most important thing to get is that when this bomb goes off, the shrapnel hits everyone. Of course, the debtors suffer, but so do the savers, whose banks might be at risk. Retirees watch their 401ks crash, workers who did everything right get laid off, and ultimately, who's left to foot the bill for any bailouts? The taxpayers. Nobody is truly safe from this.
Okay, we've seen the problem and the potential devastation. I get it, it's scary stuff. But this isn't just about doom and gloom. It's about getting smart and taking action. So how do you protect yourself? Let's get into your survival plan.
If you have debt, there are two main strategies, two playbooks. First is the avalanche method. That's where you focus on paying off the card with the highest interest rate first. Mathematically, this is the best way to do it. It will save you the most money in the long run. The other is the snowball method. With this one, you pay off your smallest balance first, regardless of the interest rate. This is psychologically really powerful because getting those quick wins helps build momentum. The best one is the one you'll actually stick with.
For anyone carrying a balance right now, your plan needs to be urgent. First, you have to stop the bleeding. No more new debt. Period. Then, get on the phone with your credit card companies and negotiate for a lower rate. You'd be surprised what they'll do to keep you paying. From there, you attack the principal from all sides. Increase your income with a side hustle, ruthlessly slash your expenses, and throw any unexpected money, like a tax refund, directly at that debt.
And hey, if you're debt-free, that's amazing. But don't get complacent. Your job now is to build a financial fortress around yourself. That starts with a 3 to 6 month emergency fund in cash where you can get to it. Treat your credit cards like debit cards. Only charge what you can pay off immediately and then automate the full payment so you never forget. And maybe most importantly, as your income grows over time, resist the urge to inflate your lifestyle. Save and invest that difference instead.
Look, the math here is undeniable. $1 trillion in high-interest debt, combined with stagnant wages and rising costs, it all but guarantees a crisis. The only real questions are when it will happen and how bad it will be. So the uncomfortable question you have to ask yourself is this. The bomb is ticking. Are you standing in the blast radius?